And I would like to now invite Jonathan Hera. Jonathan managed the RBC generator. It's a $10 million fund dedicated to investing in and supporting small enterprises that positively support social and environmental change within Canada. Prior to joining RBC, a social finance initiative, Jonathan worked on market development of, what do you know, SVX at Mars for impact investing. Prior to this, Jonathan served as Director Investor Relations of Saruna Asset Management. In addition, he held an advisory committee role with GIN Impact Base. Before his time with Saruna, Jonathan worked with World Bank CGAP on a third-party microfinance initiative with MEDA on capital raising and internal control system development for microfinance institutions in Paraguay. He is a course director at Schulich School of Business. He is a CFA Level 2 candidate and speaks proficient Spanish and Deutsch. He holds an international MBA from Schulich School of Business at York University, received his BA in political science and Italian from McGill University. But you never said in your bio that you speak Italian. And earned a non-profit leadership diploma from the University of East Costa Rica. Please help me welcome Jonathan, and he will delve deep into the subject of impact investing.
Hi everyone. Thanks for having me this evening. It was a really warm welcome. So the preface I'm going to make first off is that the content that I'm going to provide is relatively heavy. It's left a little bit more as a takeaway or a leave behind. So certainly not as slick as my predecessor Adam. Yet the content might be redundant in some places. The point is to contextualize and situate as much as possible. So I roughly have three main sections. The first is, what is an impact investor? So what differentiates us from a traditional investor? The second section is financing 101. I'm going to walk you through probably more on the equity side and debt, but I will start with debt and actually have a couple slides on grants up front. And at the very, very end, I'll color the picture as much as possible with a bit of a description of what the generator fund, that $10 million pool of capital, is all about. And I can speak in general terms about a couple of the deals that have been announced to try and provide that color. All right, so the first few slides, Adam did a great job, a much better job than I can do in covering off. So the demand is there globally and locally across a whole slew of sectors. All right, fair enough, great. Supply, there are a whole slew of impact investors. This is basically a value chain of investor types, starting from really, really small to fairly large at the end, pension funds, FIs, so on and so forth. SFOs and MFOs are single-family or multi-family offices. In Canada, you don't really see too many endowments playing in the space, perhaps with SRI, socially responsible investments, but not necessarily in the impact space quite yet. That is not the case in the US, where they are a little bit more involved. Financial institutions, obviously RBC is involved, TD is certainly getting a little bit more active. Don't be surprised if you hear a big announcement from them by end of year. And this week, Goldman Sachs and Morgan Stanley had big announcements as well. Goldman Sachs, $250 million domestic-facing fund, really, really big capital commitment to impact investing. And Morgan Stanley, $1 billion institute for impact investing. I'm not sure exactly what the details are. But the point is, large financial institutions, global players are looking at the space. It's not just boutique private equity funds. It's not just private or family foundations. It's not just high net worths who have a leading heart. It really is pension funds, it is financial institutions, and governments. The Ontario government, MEDT, has made a strong commitment to social enterprise. It's a small fund, but a strong commitment among other pillars. And more importantly, CETA, DFATE, EDC in Canada, and then their equivalents around the world are heavily involved as DFIs, development finance institutions, with impact investing. So the point is, a whole slew of impact investors are already very, very active in this space. And as Adam mentioned, a whole slew of asset classes. It can run from just cash and cash equivalents to really long-term strategies. It can run public if it's possible, public debt and public equity. On the bottom there is the most important point though. Most deals, and I think Adam had that chart if you can recall the pie graph, speaking to most deals being on private debt, private equity positions. And not all asset classes are fully developed. So you're going to be, if you're looking to allocate your portfolio 100% to impact, you may have to find comfort dealing with overexposure in certain things. Guarantees first loss position. I think this is a really interesting space. Charles spoke about collaboration, right? This is a really key attribute, not just for social entrepreneurs, but for impact investors as well. One thing that we look for is a foundation to partner with, or a senior lender to partner with, and this is just a theoretical example, of course. The foundation might act as a really strong first loss partner for us, really supporting the innovation, moving from ideation to validation. And then we can come in, and we, not being RBC, but a player like a VC or something like that, or a venture philanthropist or a venture debt provider, to layer on top of them, slightly de-risked, and so we can talk about returns later, but then situating ourselves and the company well for follow-on investors to come on later. So guarantees and first loss positions are very, very common by foundations and in certain cases, some venture debt folks. Anyway, so a slew of asset classes, but more activity in certain sectors than others. So let's talk a little bit. I got a couple of slides here on portfolio management or portfolio allocation. I think this is really, really important to recognize. Although you can invest in public equities or public debt as an impact investor, think about a municipal bond or something like that that have some strong impact, or certain companies that might be doing great things that are publicly listed. To be an impact investor in general, it's quite an active strategy. It's not a traditional passive investment where you just invest or lend, and then hopefully you hear from the company every 6 months or something like that. You really do have to think about portfolio management all the time, and portfolio allocation obviously as well. Now, when thinking about allocation, I've started to allude to this already. There are a few ways to do it. Everyone's familiar with social responsible investments? Yes? Yes? Perfect, that's the right answer, good. So most of those are utilizing a responsible or sustainable theme, and that's a negative screen. That means we will not invest in certain themes, right? Weaponry would be an example, alcohol, tobacco, so on and so forth. You can sort of identify the 10 themes that might not be invested. That's using a negative screen. Compare that to impact investing, that's a positive intent, right? That was part of the definition provided earlier. All right, so that leads us to that second bullet there, thematic or impact first. So thematic would mean just the sectors that we're interested in. That was one of the slides, the first slide I actually presented. So we're really interested in the water sector. So the theme is water, and maybe you can dive a little bit deeper, like wastewater or stuff like that, but the point is, you've got a thematic focus to your portfolio already. Impact first. That's that layering element that I was already talking about. Foundations might be really focused on job creation, right? Proving out an idea and developing as many jobs as possible. Maybe a financial first investor that comes in after something's de-risked is just really interested in a financial return. The impact is just this nice little side benefit. Anyway, so you can have impact first or financial first. In this space, you'll see investment sizes vary quite significantly. Obviously, that makes sense when thinking about public asset classes. But you can talk about you can be talking about project finance type deals, or you can be talking about $25,000 microloans. You can really run the gamut quite quickly. The interesting piece is the bottom two points. There might be some, by investing in certain sectors, you might actually be getting some upside, right? By investing in certain things. The clean tech play may not have worked very well over the last few years, but investing in certain subsectors may have proved to be very, very successful financially, and you're also contributing this great environmental component to it. And Ron Cordes, who is founder of Genworth Financial and is now the founder of Impact Assets, he always speaks to this last point. He's heavily invested in microfinance. So 2008 came along, and he did really, really well. So there's actually a negative correlation. By investing in emerging market microfinance institutions and the vehicles that finance those, he actually did really, really well compared to most markets and most portfolios. All right, so what differentiates impact investors from others? There's this additional due diligence that is required. And that due diligence obviously runs into the monitoring, reporting, and evaluation piece once the commitment is made. However, the impact piece is most important. So you have to have a mission or a vision or mandate fit right up front, right? So you just have to understand the ethics or the moral position of the enterprise or the fund, and you need to be able to recognize the strategy. You need to understand how reporting is done, and you need to actually understand how that investment will lead to impact. So you may not have that enterprise that you are working on as founders may or may not have impact created right now, but working with a potential impact investor, creating the metrics that will generate certain impact over whatever delta you're looking at, vis-a-vis this baseline 0, if that's the case, it needs to be worked on, and that's before commitment is made. And then everyone is going to talk about investing in people, right? Character is a huge piece, whether it's debt or equity, whether it's an angel round or capital markets, M&A or IPO. The management team, the CEO, the fund manager, the bench underneath that, hugely important. Even more important in impact investing. You need to make sure as an investor that the entire team that mission and vision just resonates throughout that team. There are a few ways to invest, and I'll leave that first bullet point. The point is, I'm not going to screen a public equity deal the same way I would a private equity deal. I think that's clear enough. And I will say the final point there is a thematic investment is not an automatic impact investment. You can invest in a water company, and maybe it is a net user of resources, right? That doesn't necessarily you're creating positive impact. You could be creating negative impact. So just because it's a water company doesn't mean it's a good impact investment for your portfolio. Any questions as to what an impact investor may or may not be? All right, so I'm going to do a really high-level finance 101, and before I dive into that, we're just going to talk a little bit about founder or company type, and move on from there, and then overlay that with company stage. So there are in general, two types of companies, lifestyle or high growth, and there are going to be types of financing that are appropriate for either. All of the bullets underneath are basic ways to describe either or. And realize this isn't a binary decision, it's more often a spectrum, especially when you're talking about social enterprise where you may, I don't want to use the word concessionary, where you may have at times concessionary financial return for greater impact, and over time that can change. But it's a little bit more of a gray area than simply binary lifestyle or high growth. But nevertheless, these are a few things that are really, really important when considering the type of company you are. On the top there, I apologize for the formatting there. On the top is where every angel in VC wants to invest, right? You're cheap, you're growing really, really fast, and it's going to be a home run. Unfortunately, at least 90% of companies aren't necessarily there. And so you're going to be sitting, in most cases, on the bottom left, right? So small CapEx could be a very, very good business, but traditional debt is probably what is most utilized. All right, now let's overlay that with the stage of company. You're probably all familiar with these. Idea, you've got an idea and not much else. You may be working on R&D and that's it. Validation, you've got a demonstration plan, you've got an MVP in place, and you've got some beta clients, something like that. Efficiency, you're working out the kinks and you're starting to work on commercialization. Early growth stage, you've got some capital for sure, and you're entering a new market or something like that. You've got new products on the way, but you've got products that are existing and doing well with customers, and obviously scaling is just growing even further. Overlay that with the types of company that we described a second ago. Sources of funds, we've got debt and equity that is probably available at most times in theory. Adam talked about capital raising, capital formation can take a really, really long time, regardless of where you are in terms of the stage of development, but it's certainly where you are when you are at the beginning of your life cycle. Not much else I want to add there. This is pretty straightforward. Let's talk about a few different sources of capital, and then we'll start talking about some of the intricacies. So grants, I think, are a great opportunity for many companies. Obviously, it's non-dilutive, and it can be accessible from numerous sources. The string attached is there's a lot of reporting. So if you were to obtain financing, grant financing from multiple sources, your job has got a lot more difficult. There's a lot of burdens there with the reporting required. Here are a couple of sources there that speak to all the grant funding available to you. And here are a few really good examples, most of which you're probably familiar with. The point is, there are a lot of incentives here in Canada, here in Ontario, that other countries do not have, and here are a few of the examples. All right, so let's move beyond grants and just talk about the traditional debt versus equity split. And I'm going to spend a bit more time on each of them, but here's the first slide. In general, debt is lower risk, equity is higher risk. And what does that mean? If I provide you debt, in theory, I'm going to be situated on top of equity investors. That means the founders and any other angel investor who's invested equity. And then within equity, obviously, there's a hierarchy as well, preferred versus common, and then there can be share classes beyond that. Within debt, you can have a senior lender or a subordinated debt lender. But the point is, the debt players will get their money back first and before any equity player. Relatively inexpensive. Those familiar with finance understand that mezz finance can be 16, 18%. That's not cheap. But compared to the cost of capital of providing equity to an equity investor, it's still relatively inexpensive. And senior debt, however, will be quite cheap, 6, 7, 8%. Obviously, those lenders will have first lien on assets. There's got to be some collateral in most cases that a lender can bite into. And so when thinking about it depends on what kind of company you are. But you're going to have some inventory in some cases. You'll have a lot of physical assets in that case. You may have IP that can be grabbed a hold of. Versus equity. So as I said, pretty high risk. You're investing in the founder, right? In most cases, you're investing in obviously the product and the market and the product market fit. Of course you are. But at an early stage, which is what I think we're talking about most of the time in this room, we're investing in the founders and the co-founders. And so you're investing, you're living and dying with that company. You need to support that company as much as possible. And it's unsecured, of course. What you can do, and something we're going to talk about a lot for the rest of the session here, is control governance as much as possible. So whenever we're thinking about receiving financing or providing financing, we're thinking about economics, we're thinking about governance. What can we control? So governance is just control. If we can control the economics, excellent, but I also want to have some piece of control governance. That might be a board seat, as an example, or a veto here and there, things like that. So there's the split, debt versus equity. When we're talking about early stage companies, debt can be pretty difficult to provide. Why? Collateral, yeah? What?
No income.
No income, right. So how are you going to service that debt, right? And if you do have income, it might be lumpy, right? So cash flow is pretty lumpy. So venture debt might be a decent option. That doesn't exist that much. But the point with venture debt, something that an impact investor might be a good source for, would be someone willing to offer a grace period, interest only, a really long amortization, interest rates that step depending on milestones that you might want to work out with the founder. There are many things that are variable, but a traditional lender would probably say no at such an early stage. So in most cases, you're left with an equity play. And depending on what type of business you are, high growth or lifestyle, an investor may or may not see an opportunity. You might have a great business, but it might not be VC or angel backable. Can anyone explain to me why it might not be perceived to be backable from a VC or an angel's perspective? Yes?
Because a VC or an angel expects, I believe, it's a 20 to 30% return by the time they exit. And if it's a lifestyle company, that doesn't happen. You need to have that kind of growth to really give them the confidence that they have a chance of getting that kind of return. And even if things go really well with the lifestyle type thing, you can't get that kind of return.
Did you want to add to that?
I thought the return they're looking for is much higher. That,
Do you want to tell us what it is?
well, they're, you know, I guess within every, there's what the, used to be the, I think it's like the 842, in every VC fund you'll have, you know, two companies that are the, out of the ballpark successes, you know, with returns of, you know, 500% in a couple of years kind of thing. And then you've got 4 that go sideways, and then you've got 8 of them that don't do anything at all, that kind of thing. So I think they're net they're after a really high return.
Yeah, absolutely. So I will say the 20 to 30% would be a private equity play. Yeah, that's an IRR, or compounded annually over whatever time. The 10x or higher, and that's a multiple on capital, that's not IRR, is certainly what the VCs are playing. And so they need to see that, they're saying they need to see it within 5 years, but that doesn't really happen as much as they'd like to think. But the point is, there need to be a couple of home runs for the entire fund. And more importantly, with an angel, it's a little bit different. I'm going to talk to you about an angel profile fairly soon. But with a VC, they're reporting to other LPs, right? They're investors. So they have to play in an opportunity where they see your company, and let's say it's worth $10 million, the valuation is $10 million, and they need a 10x. Let's just use the numbers that I started to describe. Your company needs to be valued at $100 million in 5 years, as an example, right? So they took whatever position they did when you were valued at 10, you're now at 100, they keep that position, there's their 10x. They need to hit that. So that's what they strive for. And so a lifestyle business, exactly to your point, in many cases they may be great businesses, they may be throwing off a lot of cash, but they're still not enough to generate VC backing. So there's you see there's an issue there. You may not be ready for debt financing. Equity financing may or may not be available to you, depending on the kind of business you're at. And so this is where impact investors can play a role. This is where a lot of differentiated angels can play a role, and this is certainly somewhere that I play from a financial institution. But I wouldn't say there's a perfect solution. So let's talk really briefly about debt. These are going to be basics. I apologize, but let's just continue to roll through it. So the 5 C's, everyone's familiar with these, and characters up front, it's the most important one. Capacity, we can work around that in many ways. Of course, you need to repay that loan, but we can talk about innovative structures in order to do that. And then understanding the conditions, that 4th point is really, really important. So there's that seasonality, there's that lumpiness of cash flows that we could consider. Collateral, well, and a subordinated debt lender may provide an unsecured loan. Those who are willing to promote innovation and get past innovation towards implementation and execution, especially in the impact space, to promote the social entrepreneurs, are willing to do that in many cases. All right, so what are we backing? We already talked about this. We're not looking necessarily at collateral value. We're not looking at a really great structure. We need to see cash flow, right? In most cases, that's the case. It's not collateral value. It's not asset backed, and it's not some guarantee or some fancy structure. It really is the cash flow. It is the business model itself that we're backing. Here are some of the questions that we ask, and these are the same sorts of things that an investor will ask. First and foremost, management team, all right? And so if you're a single founder, while you can attract capital, co-founders in most cases, at least 2, are what are preferred. And why is that? Can anyone tell me why at least 2 co-founders is what we look for?
The risk is distributed.
Distributed risk, yes, for sure. And keep going with that point though. Anyone else?
Collective strength.
Collective strength, yes.
Complementary skills.
Complementary skills, that's exactly it. So you've got a bright and shiny person that can do all the business development, and then you've got a nose to the grindstone, head down CTO, as an example, right? So you've got some really complementary skill sets that to work with. And so the 2 of you will hopefully create some nice synergies, and it's really, really difficult for a single founder to do everything really, really well and move through enough of the life cycles of a business successfully. All right, so how have you done in the past? When we're talking about early stage companies, and I should have said this earlier on, we're talking about private, we're talking about fairly small, and I assume, I make the assumption in most cases that we understand that because social enterprise as an industry or a sector is fairly nascent in Canada, and so most of the organizations are fairly small. So, but I should have made that clear, so I apologize. So you might not have 3 years of audited financials. You probably don't. Do you have 12 months operating experience? Maybe, and we can certainly talk. So you don't need to have audited financials, but tell us how you've done. Tell us where the money is going, right? So use of capital is hugely important. When is it needed? Obviously, let me just deal with the capital formation question here. We can start a conversation tonight, and I'm going to get to know you because everything's based on management, right? And I have to build a relationship. I have to trust you, and that's going to take some time. You can send me your proposed term sheet, and you can even send me some shareholders agreement from the last round that you raised. That's all great. But if we don't like one another, if we don't think that there are going to be synergies, it doesn't matter, right? So the point is, building that relationship, building that trust will take quite some time. So getting down to the due diligence, and this is what Adam was speaking to, that relationship development will still take quite some time. You might have a lot of documentation in front of you, but if you don't have that complementarity, it doesn't really matter. Once you actually get down to real due diligence, the 60 to 90 day process in general will hold true, absolutely, but it could take a year and a half before you get to that point. So when do you need the money? So always talk to investors as early as possible. Don't pitch them formally, always ask for their advice. What do you think about this market? What do you think about this product? What do you think about this feature? So on and so forth. Don't pitch, just get their advice. And you're gonna hear 10 million different things and they're all contradictory. But take that feedback and engage with it, learn from it, and then get ready for the pitch later on. When and how will we back? Right, fair enough. And service providers, I think, is a good thing. We're here at Gowlings. There are a number of programs that a number of law firms offer to startups that are really low cost. And so that's something to take advantage of. Getting someone who is used to not only social enterprise, which they now have at a few firms, and not only VC, but maybe your industry specific. All right, primary uses of debt. I think we've covered this. Negotiating loan. There are a few main points. We're going to spend a lot more time on equity arrangements, and I think you'll understand why now that we've talked about some of the financing gaps that we've addressed. In terms of loan, interest rate. What's the coupon rate? How much are you going to have to pay for that money? How long is it going to take you to hold that before it's all due? What does the repayment schedule look like? So is there a grace period up front? Is it interest only? Is it principal and interest? What does that look like? And any loan covenants. So loan covenants are really important. They're negative and positive. There's a lot of things that you must do or you cannot do. And I have actually a slide later on from the equity section that says, you can name the valuation, but if I can name all the other terms, I'm happy. And that's from the VC or the investor's perspective. So the loan covenants here, negative and positive, again, are really important for you to understand. All right, equity. Any questions on debt? Sorry. Excellent. All right, let's go on to equity. 3 main sources, friends and family. I'll leave out the fools. This is a great source of capital to get started, right? It's probably going to be, in most cases, the first capital that comes in. And it's super flexible, but you have to be aware of that, the relationships at play, especially as you bring on later financing, right? So an angel or especially a VC may or may not want those friends and families in. How do you deal with that? That's a huge concern that you need to be thinking about earlier on. Angels, and I think I've got a slide on angels specifically. These folks are industry professionals, well-to-do, high-net-worth individuals. They're probably focused on a few key functions or industries. They're focused on a few key geographies, and they like to come in early. So they'll be the first ones in after friends and family or your own capital, after you realize you can no longer bootstrap on your own. Yes, oftentimes they're interested in early exits, but that's not necessarily true. Some do take a more patient capital or a long-term approach. It really depends on with whom you're speaking. But just to give you a sense of numbers, we talked about a 10x over 5 years. And there's that number there. That's a fairly traditional VC target here. And that's a 58% IRR. 2.5x in 2 years is the same IRR, right? So they may want to get out of the company, they may want you to sell. You haven't accomplished all of your goals as a founder where you want to take the company. And so you may have some issues. So one thing we're going to speak to a little bit later on is alignment. Investor and founder alignment is key, no matter what kind of investor, even lender. And third would be a VC. So these guys these men and women are quite important. They don't make as many deals as an angel. This is something to recognize with an angel. An angel will be able to sprinkle 25,000, 50,000 here and there and everywhere. A VC will certainly drop a lot more on a specific company, but then they only have 10 companies in their portfolio. So if they have 3 managing partners or 3 partners and 1 managing partner, or 2, then you've got 3 to 5 companies that each of them looks after. An angel can have a portfolio of 10 companies on his or her own, and you might have more angels than just the 1. And so you need to think about alignment of interest, conflict of interest, things like that. So very different sources of capital coming out at a later stage, the VC, than angel, which comes on earlier. But things to think about as you progress your company and move towards that later stage. When thinking about attracting VCs, you need to make sure you know how to do that, and angels will play a key role. All right, so the most important thing on this slide is understand who you are pitching. Understand who you are targeting. Don't send me a cold call or a cold email. All VCs will probably state that they're inundated with amazing opportunities, right? We're a network-based industry. It's a fairly small community, especially in Toronto or in Canada. And so warm introductions go a really long way. So that can be other VCs, that can be company CEOs, that can be all the service providers. But introductions go a really, really long way. So when you finally get to meet with me or any of my colleagues, understand what it is that I do. Take a look at LinkedIn and take a look at our website. Understand the kinds of companies that we look at, the stage of companies, the sectors that we look at, the geographies. Do all of it. You need to work on that alignment. And when I spoke about impact investors, that mission, vision, mandate, that's a huge fit component that you need to think about as well. So the most important thing here is to understand who you're pitching. As a quick example, you're targeting an institutional investor. They're probably not going to care about impact. They probably will not. So if you have impact, that's excellent, but demonstrate the rigor and business discipline and the financial returns that are available. If you're speaking to a foundation, speak about the impact that you've generated, and you can talk about revenue targets and projections over the next few years, but know that that's not necessarily the most important driver in making a decision. So really make sure you target your audience appropriately. And whatever advisors or board members that you have, these folks, you brought them on for a reason. So these are the folks that should really help with the introductions and really come along with you when making pitches to VCs or other angel groups. All right, so what are angels? Kind of described this already. Let's do it quickly. Well-to-do professionals and private individuals. Private and individuals. They're normally specific. So we've got in Toronto, we've got Maple Leaf Angels and York One. There's probably more, and I'm forgetting them right now. In Waterloo, we've got Golden Triangle Angel Net, Capital Angel Network in Ottawa, so on and so forth. Geography specific, right? They're also industry specific. So Waterloo would probably make sense that they have a heavy tech focus. Some of the other groups have a little bit more of a clean tech focus, so on and so forth. They do come in earlier and they're investing less than a venture capitalist. But they provide invaluable experience. These are the folks that will often join your board in many cases, or help with great networking, or help with pricing models or distribution, marketing, strategy, because they have this industry-specific functional and industry expertise. Compare that to a venture capitalist. We've covered the first couple of bullets. The most important point for the venture capitalist, yes, they're investing a lot more money, but they have to align interests. Alignment of interests here is crucial. Not only are they looking to generate high returns off of investing in you, and they do want to make sure that you have a strong upside. They wouldn't invest if they didn't see that. We kind of talked about that earlier. They also have to make sure their interests are aligned with all of the limited partners, or LPs, or investors basically, that invested into their fund. Okay? That's a really important consideration. So think about this very, very simply. You've got 10 investors that invest in a fund of $100 million. That $100 million fund will invest over a 3 or 4 year period into 10 companies. The fund life is only 7 to 10 years, and so they have to start harvesting these deals pretty quickly in order to get returns back to the LPs. There's a lot of moving pieces in this venture capital fund model, and so it's really, really important to juggle interest alignment. Clear? Yes?
I've heard recently that a lot of VCs are having a lot of trouble closing their funds. Would you agree that that is the case, or is that just gossip?
Can anyone confirm or deny? So I would say that Canadian venture capital is, I think, I'm being filmed. I think the startup communities in many, many cities are amazing. So the incubators and accelerator programs are amazing. Angel networks, my experience is only here in Southwestern Ontario, is amazing, vis-a-vis where they were a few years ago. So there's a lot of money going into a lot of early stage deals, which is excellent. And I think venture capitalists are pretty active. I think Canadian venture capital is pretty strong, but I won't say that there's as much money as there could be for the space. So are they a little bit dry? Yes, I would tend to agree, but I think there's a lot of promise, and I think we're going to see some changes really, really soon. I can sit on the fence with that kind of answer. Yes?
I just want to find out what's MOC.
Multiple on capital. So there's a few, multiple on capital, thank you. I'm sure there are acronyms sprinkled throughout. Multiple on capital, 10x. I invest 10 million, I want 100 million out within 5 years. And as you saw in the IRR, that means, which is internal rate of return, that means 58% compound annually. So yes, I think there's a lot of VC money out there. Banks used to be heavily involved in venture capital. There are now some regulations like Volcker and so on and so forth that make it actually very difficult for financial institutions in the US and Canada to actually have venture capital arms. But anyway, that's just an aside. So what is exactly that venture capitalists do? Take the first 4 points there, that's 25% of their time. That's all deal sourcing and getting to commitment, okay? And that happens at the beginning of the fund, right? So where does the bulk of the time sit? Managing that company, monitoring, getting it ready for exit, right? So it's really the heavy lifting, the fun part, happens after the investment's made, okay? And venture capitalism is you can be slightly passive, but in general, venture capital and angel investing can be very, very active. So folks in most cases will want to help the entrepreneur. And if you don't want that, if you just want our money and tell us to get out of the way, you need to make sure that you do so. So again, that's alignment of interest. When you're doing your due diligence and you begin to understand the investor, if you find out that he or she doesn't like to get involved and you really need some specific skill to complement what you're doing, then that person probably isn't the best fit. Is that fair? Everyone understands that, I assume. Okay, so let's go on to a few nuts and bolts. So what's a term sheet? Everyone's familiar with a term sheet, I presume?
Yes.
Yes?
Yes.
Okay, so a term sheet is somewhat legally binding, but not really. It's basically a roadmap. This is when you've conducted a lot of your due diligence, but not all of it is complete. And you start working with at least one investor, perhaps a syndicate of investors, a group of investors, and you want to start structuring how an investment might look. All right, so that's that roadmap. And all of the real legal documentation builds off of the term sheet. So what it is that you want to talk about, well, you want to talk about where that money's going, what kind of security you're actually offering, the structure, and the pricing. And there's a bunch of things that we'll talk about after that. But it's the first step. All right, so what should be your concerns, whether you're thinking about taking on debt or equity? This is really, really relevant to equity, but it applies to both. Loss of control. So remember I said economics or governance. Loss of control. What if the investor group that comes in, you've taken their money, you've just needed the money, and one of the terms within the term sheet and then the subscription agreement was that 3 independent board seats come on. You now have to institute a 5-person board, and there are only 2 founders that can sit on the board and 3 independent board members. You've just lost control. So it's something you need to consider. Are you willing to do that? If you've got great board members, perhaps. And then there's the economics piece, dilution. How much are you willing to give up? And when? And to whom? Okay? When you're giving that money up, let's say you're giving away 20% for $2 million, just to keep simple numbers, where will that $2 million get you? So are your financing plans appropriate? And where will that get you? So we're talking about runway. What kind of milestones will you have along that runway? And what future capital needs will you have after you get to that certain next milestone? Is that clear? These are some of the things that, as an investor, we think are your main concerns. Any questions there? All right, and what do we care about? Again, there's economics and governance. So we want to make sure if we're investing in equity, the valuation is fairly accurate, present and projected. We want to understand the risk level, so there's where we always hear about risk-adjusted rate of return. We want to make sure that there's an element of liquidity, something that I haven't mentioned and I assume is well understood, but let's just make sure it's clear. When we're investing as an angel or a VC, and we're investing in equity, and we talk about these time horizons of 7 years or 5 years, what does that mean? That means that investment is entirely illiquid for that time period, right? Now, you're talking about pref shares, there might be some dividends or something, but anyway, let's keep that aside. So it's fairly illiquid. So if you want to build in liquidity, how are you going to do that? How long are you going to stay in? It's a really important consideration. If the company is doing well, I want to make sure that I can continually invest the amount, the percentage that I was in before, right? So that's what's called pro rata participation there. And clearly, since I think I have all of the answers to all of your problems, I want to make sure that I can control your strategy and management as much as possible, right? So there's veto rights and there's voting and boards and positions and things like that. Any questions on that one? All right, I'm boring everyone to tears. All right, so a few options on the equity side. A convertible note, which is quasi-equity, and I'll spend a second on it in a second. There's common and preferred shares, and the difference there is sometimes you have a dividend, but you'll always have priority over common. So remember at the outset, I talked about the structure. Debt comes first, then comes equity. Well, then within there are variations, and preferred would come before common here. What's most common in this space is common is the founders, and angels will often come in at common as well. VCs, however, will come in at preferred, but they do give up their voting rights as a drawback there. And then there's some options and warrants. Options are outstanding stock, and we'll specifically speak to employee options, ESOPs, employee stock option plan in a second. And warrants would be the issuing of new stock. So you may take a certain amount of shares, but you may also take a piece of options or warrants in the future as part of the financing arrangement. Okay, so let's talk about convertible notes. It's quasi-equity for a reason. Is everyone familiar with convertible note? Okay, one person, a couple people, excellent. So there could be some conversion from debt to equity, okay? And there could be a couple of triggers. An automatic, which is the one that we always like to see, is the automatic conversion on qualified financing. So let's say within that term sheet that we say, should you raise, let's say that we're looking to raise $1 million right now, and we're going to do so with a convertible note. So in 2 years' time, because that's going to give you 2 years of runway, you're going to raise $3 million. If you hit $3 million raised, our debt will automatically convert into equity. Is that understood? So it's an automatic trigger, okay? If you never raise that, then we'll stay as debt. Is that clear? So there's an automatic trigger there. However, since we came in 2 years before those other investors, we're going to ask for a discount when we convert. And the most common discount is 20%. So what does that mean? So we were buying, you have a question? No? Okay. So we were going to be buying it, whatever, $10 a share, and it's for $3 million overall. And we get a 20% discount, so ours are $8, right? Because we came in earlier, we came in at a much riskier stage, we get that discount. Sometimes we talk about a valuation cap on the next round as well. So what does that mean? Can anyone tell me what that means? What's a valuation cap? Why would I have put a valuation cap on the financing of your next round when thinking about conversion?
To protect dilution.
Dilution? Tell me more than just the word dilution.
Well, if you've invested, or if the convertible notes for 100,000
Yeah.
and the valuation cap would protect, how to explain this? If you've invested the 100,000, you're coming up to the next round and you're going for, I don't know, $1 million, then the cap might be to keep it under, say, 2 million or 5 million, because 100,000 is 10% of $1 million. So if at that point it would convert to 10% in equity, that would be one thing. But if you end up raising 5 million, I can't do the math on that, so let's say if you end up raising 2 million, that would take it down to 5% in equity, and you want to maintain as much equity as possible when you convert. Does that make any sense?
Yeah, it did.
Oh, yeah.
They'll give price per share ceiling.
Yeah, exactly. Price per share ceiling. So that's exactly it. You got it. It was your answer was correct. A little more eloquent response, but it is correct. Okay. So other things that are talked about are interest rate, maturity date, collateral secured or not, and percentage required to amend the terms. So how much of that 1 million convertible note is owned by what investor group in order to amend the terms. Convertible notes are often used in the angel space, I would say. It's fairly common right now. Why is it really common, or fairly common? Yes?
Because it's incredibly difficult to agree on valuation, especially if you're pre-revenue, and even the closest thing that you can align to is still just a guess. So this way it kind of protects both sides until you can get to a point where you can better pinpoint a more likely agreeable valuation.
Yeah. Did everyone understand that? Is that fairly clear? You're kicking the can down the road, maybe leaving it to others, or maybe renegotiating at some other point. Exactly. Good. Okay. So one thing that we got to think about when talking about dilution, talking about giving up control, is the goal, which is to increase the value of the company. Here we're actually talking about increasing the size of the pie, not necessarily the percentage owned of the pie. So if you just follow the pie slivers, you'll see that the light blue, the founders, continually own less and less of the company. But if you'll run the math really quickly on, let's say, a $10 million pie, and the founders own 80% perhaps, and they have a 20% option plan, then there's $8 million in theory. And if this big pie then is they're owning 40%, and the company's now worth $200 million, then they own much less in terms of percent, but overall, they own a lot more. Fair enough? Fairly simple. All right. Pre-money valuation, everyone's familiar with pre-money and post-money. So pre-money is how much is let's just say we're not using a convertible note, and we're actually going to price the company, perform a valuation on the company. How much is it worth prior to investment? Simple enough, okay? How much is it worth prior to investment? And make sure that when you're talking with an angel or a VC and you're going to perform, you're going to offer equity, you know that you're talking pre-money or post-money. It's really simple, but make sure you talk about it very explicitly. Talking about a $2 million company, pre-money or post-money, when raising $1 million is a huge factor, right? Does everyone understand these basics? Okay, really simple concept. If you get caught in it, you wouldn't be the first, so that's why I just want to spell that out. All right, I mentioned that ESOP. Is everyone familiar with the employee stock option plan? So, let's say you're a high growth company, or you're a company with pre-revenue, and you don't have enough money. And you can't repay debt, so how are you going to necessarily pay employees? One way to incent employees might be to provide shares, and this is certainly something that you'll see in almost all Silicon Valley companies, right? And something you see a lot here as well. So you're offering up a certain amount of the company to employees, either current or future. Fair enough? What does that look like for an investor? I've got these two slides. You'll see the same pie, but you'll see something very, very different. In this case, it's 1/3 for the investors. That's what we're coming in at, and the founders will still own 2/3. When offering that option plan, where does that money come from?
Depends on your term sheet.
Yes, more complex than what was mentioned. Earnings, sure, but where does that pie slice come from? More simply.
Usually the founders.
Yeah, the founders. So, if you don't have an ESOP in place, an investor forces an ESOP into your company, which is normally a good thing to align interests with the team and the founders and to support your growth. Be very, very aware of the fact that you've now just given up 20% of your company to put a 20% ESOP in place. The investors still have their 1/3, right? So there's some major dilution that can occur. Okay, so again, be very, very aware of that. Very simple thing, but something to be aware of. Okay, so valuation is something that got talked about so much, but it's not the most important thing. It really isn't. If you have some hubris and you really need to get a really strong price or value for your company, you've got to remember that this is a negotiation. And so in order to get that valuation, it might help you right now, but you're going to have to probably give up on other things. And if you get too high of a valuation right now, you've got to think about what happens to the next round of financing as well. If you have a really high valuation right now, and you perform reasonably well, but not amazingly well, will you necessarily attract the investors at the price that would be conducive to generating more business or more growth for your company? Clear? So I would say be really, really lean. Don't be greedy on the first couple of times you raise capital. And if you are going to do that, then the VC can still control a lot, and we'll talk about a few things. So anti-dilution protection, this is this downside piece. So let's say that we raised $5 million. No, let's just say the company's valued at $5 million, and this is post-money, right? So after investment dollars are in. Now you're raising another round, and the investors are saying that the company is only worth $5 million or $4 million. It's actually worth less than after your money went in, or the same, right? So if it's actually worth less, if they're valuing the company worth less, well then you have probably bigger business model issues, unless you're launching some new products, and in which case that may happen, but we don't like to see that, obviously. The investors who came in that first time will probably have anti-dilution protection as part of a term sheet, and that'll allow them to convert some things. And many times it doesn't have to be 1-for-1, but it can be. So they get to keep the amount without diluting themselves, right? So if they had 10% before, now you're worth less, they get to keep that same amount of ownership instead of going down. Is that clear? So they build that in, so there's downside protection for themselves. Upside, so that's a big downside concern beyond valuation, and here's a big upside concern that you need to think about. So let's talk about liquidation. This is when some good news happens. It doesn't always have to be good news, but in many cases it's good news. So if you've got preferred shares, they get to get out before the common shares, right? Talking about that hierarchy, debt, equity, and then within their levels, and preferred comes before common, okay? So if you have a liquidation preference, you might have preferred coming out, and they get all of their investment first. So we threw in $5 million to the company, we get our $5 million, our principal back, okay? Before anyone else, before even the common, the founders, get any of their money back, all right? And so this is called, can be a preference overhang. There can be so much money taken out of the preference that the common might not have any value at the end of it, okay? Then there's a real catch that you need to be aware of, which is the participation. And that's at the bottom. There's non-participating, which is what you'd like to C as a founder, and then there's with cap and no cap. So let's say the investor pulls their 5 million out. They can also participate in the amount that's left over. There can be a cap on that participation. They only get to participate up to X percent, 20% of that left over. Or there can be no cap participation, which means they get to steal a lot of that upside from the founders and other investors as well. Is that clear? So pre-money valuation is one thing, but there are a couple of really, really big term sheet items that you want to talk about, and liquidation preference with participation is something that you want to be on the lookout for. Yeah.
What do you mean by participation?
So non-participation is you get your 5 million out. If it's a 1x liquidation, so you invested, sorry, I'm not being very articulate, let's walk through this. You invested 5 million some time ago. You've got a liquidation preference clause at a 1x, so that means you get your 5 million out right away. Let's say you have a 2x liquidation preference, that means you get 10 million out, right? You invested 5, you now get 10. You can have sometimes, most of the time you're gonna see a 1x, but you have seen 3x and some crazy things before. So very quickly, they can take all that the return. And then you've got non-participating, which means once they get their 5 million out at a 1x, they're done, right? And then the rest is fairly standard. Participation means there's a bunch of upside that's still left, right? You've taken your principal out, right? You can repay, and there's a whole bunch that's still left when you're selling the company. Is that understood? There's value, right? Are you going to participate in that value? And if so, are you going to cap it? I.e., how much can they participate? Or will you have it uncapped, which means whatever percentage they own, they get to participate with all the way through. So you can have a massive evaluation of your company, and then you let a VC control non-cap participating with a liquidation preference of 2. They'll steal everything, in theory, right? It's possible. Is that clear? So there are major term sheet items to think about beyond valuation. That's my point, all right? Other things, voting rights, board seats, very important. Right of first refusal, also important. How are we doing for time?
We've got another
10 minutes. Excellent. I think I'm wrapping up. I'm boring myself. Okay, right of first refusal. Let's say we're going to sell some shares in theory to a third party, while other investors that are already invested have the option of buying those first. Clear? Right of first refusal. They get to look at it first. Preemptive rights. If I've invested previously, I can take a look at investing before any other outside investor comes in. Registration rights not important. Information rights. Everyone wants information rights. You have to report to us, right? Tell us how you're doing. That's information rights. Protective provisions. This is really interesting for VCs. They, because they have a responsibility to their LPs, will want control of certain things. So this is certainly a control or governance issue. And they'll be able to, they'll ask for vetoes of certain things. And selling the company, raising additional capital, new products sometimes you'll see, changing founders. These are kinds of things that they'll want to have control over, and they'll be able to veto. So that's a protective provision. So you got to be aware of what they're asking for there. I guess dragon tag is, I'll leave that one. Reverse vesting or vesting. So when talking about bringing on advisors, at a later date, you might want to actually pay them with some company stock, right? You may want to do that. Don't give them all the stock right away. Give them a vesting period of 4 years so they earn a piece of it each year, right? Does that make sense? You're probably going to do that for your founders anyway, so do that for all of your board or advisors as well. Reverse vesting in this case is you're bringing on founder and giving it to them over time. Am I getting that right? Yeah. So you're bringing on, you might not be one of the main founders, you might come on later and are deemed to be a co-founder, and reverse vesting is slowly they earn back some of the shares or ownership of the company. So these are a few things that are important. The main ones, as I said, the valuation, anti-dilution, and liquidation with participation. These are a few other ones, but those are the big ones. All right, and what is everyone looking for? And I think that actually gets me to the generator. Here are a few of these things. So prior investment or loans, and have you been able to effectively work with those investors and repay those loans? Do we like the CEO and the co-founders, and do we like the bench underneath the team? Is it a unique idea, or is the market really, really big? Have you done a lot of really great stuff, so you're past ideation and you're past validation, or at least figuring a way through validation? Most investors will look for that revenue piece. There's not too many in Canada that will just go on an idea alone. And that's maybe a big differentiator of Canadian VC versus otherwise. Most are looking for some revenue. It's not just an idea. All right. So engaging feedback. I think this is a really, really important piece. Sure, investors can add value, blah, blah, blah. But what you need to think about, most importantly, is they're all going to provide feedback, whether it's valuable. Don't argue with it. Take it, let it distill, and don't visit with the VCs every week. Don't visit the same ones. Take some time, figure out what it is that you keep hearing, develop some trends, some patterns, and then over time, go back and repitch. Keep all of those doors open. These are long-term relationships, even before the commitment is made. So make sure that you're quite introspective and reflective on what you keep hearing. You will find trends, and then those are opportunities to work on. And I mentioned this before, and this is really unfortunate, but it's very true. Sometimes a good business is not a VC-backable business, and we had some of the folks in the audience to explain why that is. The return, while it might be great for the founders and the employees, are just not there for our venture capitalists, and that's it. All money is not created equal, so make sure that you know who you're pitching, what are the pros, what are their cons, what it is they can do for you, what can you do together. That is a huge piece that is probably the most important on the slide. All right, so what it is that I do and what are we looking for? This is the RBC generator. Is anyone familiar with the RBC generator? All right, so big marketing machines, clearly. Okay. It's a $10 million pool of capital that is investing in Canadian for-profit, social purpose businesses. Okay? Pool of capital means we don't have any wealth management clients investing in this. This is all RBC's money. And it is part of a greater RBC social finance initiative. The other components are some thought leadership, some white paper development, partnering with incubators and accelerators across the country, sponsoring events, sponsoring conferences, things like that. Those are the sectors, and how are we utilizing this capital? We're actually splitting this out, $6 million directly investing into companies, and $4 million utilizing a bit of a fund-of-funds approach. Yes?
I'm just wondering, when investors are investing in social ventures, are they still expecting a return of 10 times their investment? Because when you're talking about social enterprise, let's say we have a business to help homeless people, that's not going to be a huge money generator.
Right.
So I'm wondering, do they lower their expectations? I mean, I realize you're a bank, so you have to have high expectations, but angel investors or something,
That's a good question.
like, can some of this be a bit lower for people like us?
Yeah, absolutely. So I don't know anything about the example or your real business that you're talking about, but let's just run with it for 1 second. It's probably not a high growth business, it's probably a lifestyle business. That automatically changes what I'm able to do for you and my return expectations. Automatically, whether I'm traditional or an impact investor. So I'm already not thinking about a 10x return, okay? So first and foremost. As an impact investor, through the beginning of my hour-long spiel, I talked about the variations within that group. There are going to be some folks that are interested in investing at a very, very early stage. They might have a venture philanthropy type mindset. If they lose their money, they don't want to, but they've settled their demons. They're okay with that. If they get 2 or 3% back because they're issuing debt, right? So when you can repay, probably structured it so it's really, really friendly terms. When you can pay, that's great. So over the life of that repayment, maybe it's a 3% return. They're very comfortable with that. That'd be capital preservation, right? And perhaps a little bit of an upside there. There are plenty of investors looking at that. And when you think about portfolio allocation, even me at RBC, I'm okay with 3% return because I've got $10 million. I want some home runs, right? But I also want some that are generating massive impact. Okay, so your opportunity that lets me generate 2 or 3% return, maybe a home run on the impact piece, and preserves my capital or maybe earns a little bit for me.
So are you going to be okay with that? Like if I say I'm going to come up with this fantastic idea, I'm going to help homeless people, and so you're going to be okay saying, okay, I'll take not much of a return because I see the great thing you're going to do. That's going to be okay with you?
Theoretically. Not representing RBC, but theoretically, yes.
Okay.
There are a ton of investors out there, and more all the time, that are okay with that. Remember I talked about collaboration, okay? Sometimes, and now I'm going to speak specifically, RBC will be the impact investor, okay? Impact first. That triggers senior lenders to come sit on top of us. Is that very clear? We'll take some risk away. First loss cushion, let's say it's $1. We throw in $1, and if we lose that $1, we don't want to, but we're okay with that risk return profile, whatever that return is. And that triggers different ratios for a senior lender to throw in $3. They wouldn't have been able to do it otherwise, and now that enterprise just got $4. So everybody in theory wins. The senior lender wins, we enable them to launch that, and now you've got business, funding for your business. Other times, we'll do the exact opposite. We'll look for a foundation as an example, or a high net worth, to do that kind of de-risking for us at an earlier stage, and then we're wanting more of a financial return coming in on a later stage. Us as RBC generator. So I would say it all depends, it's contingent on many things, but the answer is yes, a 3% return in this space is a real return. Clear? Okay. Really quickly with this $10 million, I talked about the sectors, I talked about how this is being divided. Fund to funds, I'm investing in fund managers, then investing in 10, 15 companies. And we spent a lot of time talking about that BC model, so you understand what it is that I'm kind of looking at. And then directly investing $6 million. Okay? The type of investment that I'm providing, this is really interesting. Realize this is a big bank, a risk-averse financial institution, 100+ year track record lending. We'll invest with equity, and remember we talked about the structure of equity, preferred, common. We'll also invest common. Okay? So we're sitting right alongside the founder, you. So that's extremely innovative for a big bank to do. We'll also obviously look at convertible debt. So we'll kick the can down the road with valuing the company. Again, quite innovative for a big bank to do. And we'll look at between $100,000 and $500,000 for the initial investment, and we'll have follow-on financing available up to $1 million. All right? So that's what we're looking at. And so when we're looking at opportunities, what are we looking for beyond the sectors? Management team, of course, and I want to see a really strong synergy across the co-founders. We have to believe in them. We have to believe in what they're doing. We have to believe in their mandate, mission, and so on and so forth. We're looking for at least $1 revenue through the door. Okay, so this can be still pilot phase, but you need to be generating a bit of revenue. You need to have a decent enough market or a really unique market. So it can be local, and that's fine with us, but you need to have a decent carve of the market. Last slide. What do we do beyond finance? We're fairly active investors, and that should be clear, but we provide some neat linkages to a bunch of legal firms. So let's say that this is your first time raising capital and you haven't put any of the legal documentation together. We've got a short list that are willing to do this for you quite affordably. And obviously, I'm only a $10 million fund, but I can connect you to a lot of folks across the country. There are 80,000 employees at RBC, many of them experts, functional or geographic or industry. So being able to connect with them is pretty important. Any final questions? Excellent. Well, thank you very much.